All right, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be kicking off with the major equity indices. We have seen the S&P and the Nasdaq move up higher in the last few days, despite geopolitical tensions. And that should be bolstered a little bit more today, given the fact that the US retail or core retail sales has just come out at 0.6%. The forecasted figure was 0.2%. So a nice upside surprise, and I do expect that to have a positive impact on equities. That was just in the last minute or so. From there, we'll be taking a look at fixed income and commodities. We'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at just the one subsector of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. No new ideas for today, simply because one, retail sales was coming out today. And two, we're still moving along with earnings season. So we saw the major banks really post earnings the last few days. Largely, that has been quite positive, given the fact that high interest rates are, banks tend to perform well in a higher interest rate environment. So we are seeing some upside surprises. But for now, I didn't want to have new ideas, given the fact that we also had so many new ideas last week. So we'll take a look at how those ideas have been going. So S&P 500, looking at the SPY ETF, and we can see here that price has bounced above that 420 level. That was a 23.6 bib level. And the big question mark was, were we going to get a breakdown or a bounce up higher? So far, so good. We have gotten that bounce higher. And also, price is managed to stay at current levels. Now, the pre-market would have actually ignored, because the screenshot was taken just before US retail sales came out. So that will most likely actually move up a little bit higher, is my best guess, after that figure came out, because it was a nice upside surprise. It indicates consumer spending is still strong, and it indicates consumer spending is still strong in a rising interest rate environment, which is actually good news, at least in the short term for equities. The question may arise that, okay, if consumer spending is still this strong, surely one could give the green light for the Fed to keep interest rates elevated for longer, given the fact that the consumer is resilient. And with consumer spending being strong, it could also have an impact on inflation or keep inflation elevated. I wouldn't worry too much about the second point, because the Fed is more worried about labor inflation as opposed to goods inflation right now, but it's still a contributing factor. But for now, S&P 500 just still above its still below its 55-day exponential moving average, excuse me, but we could definitely get a breakout from here, and a breakout would signal a continuation back up towards that 450 level. The other thing to be obviously concerned about is the conflict in Israel and Gaza. So that is going to have largely, I wouldn't say it's impacting equities too much, but keep an eye out for commodities like oil, like gold. We have seen gold rally due to that, and we will take a look at that as well. But that is still a leading theme for markets, and any developments there will have an impact on markets as well. So the Nasdaq 100 staying strong above its 55 and 21-day exponential moving averages, running to some resistance at around 370, but not exactly reversing lower. We saw some bullish price action to kick off the week yesterday. And, continuation high here is definitely on the cards with good retail sales numbers. Next key level to be looking at would be at around 380 to 385. But the Nasdaq 100 outperforming the S&P as well. And also keep note that the Nasdaq 100 does not have the big financial institutions in its, it's not made up of any of the big financial institutions. So even though we are seeing banking earnings coming out now, it's going to have less of an impact for the Nasdaq 100 compared to the S&P 500, but there will still be some correlation because the S&P moves higher, the Nasdaq 100 so likely would still benefit from that and continue higher as well. Okay, IWM, looking at small caps here with the Russell 2000 ETF. 170 key level, which because that was a 50% fib level. Price did reach that level 2 weeks ago. Initially bounced up higher, but already ran into resistance at a 21-day exponential moving average. Came back down to retest 170 and bounced up higher once again yesterday as well, showing some good bullish price action. So 170 clearly acting as a strong support level, but obviously we can see that underperformance relative to large caps. So even though I do think, the risk reward favors the upside here for IWM, large caps are still outperforming the like the S&P and the Nasdaq. They're outperforming IWM right now. So I do think upside is somewhat limited. I do think if you're looking for broad-based bullish exposure for a major index, S&P and the Nasdaq might still be the way to go. But again, the risk reward does favor the upside here for IWM. Next key area would certainly be at 180, previous resistance zone. This area between 180 and 182 really. That was a previous resistance zone, previous support zone that has recently been broken. So keep an eye out for that level if we do see a continuation of this bounce above 170. So TLT has still been under a lot of pressure. There has been a recent pop-up higher in price, and price once again failing to break above that 21-day exponential moving average. I mean, the last time we saw a breakout above its 21-day EMA was just before September, late August. And even then, it was only for a day or so and immediately price rejecting that. So that just shows the amount of bearish momentum here for TLT. Price a little bit oversold still on the weekly time frame, but still not showing that many signs of bouncing higher. So what we could see is definitely, momentum improve on the weekly time frame, and that doesn't necessarily mean price is going to decline or bounce up higher rapidly. It could just mean that price stays a bit more neutral, maybe finds a new area of support at around this 84 level. And also, there has been a lot of talk that yields do seem to be topping off. So using that logic, TLT, the Treasury Bond ETF, may be bottoming out as well. I would say expect more neutral to slightly bearish price action. And our thesis remains the same of selling into these rallies for TLT. So if we do get a rally back up to its 21-day exponential moving average, or even the area between the 21 and 55-day exponential moving average, that will provide a good selling opportunity still. I know I've said that repeatedly in the last few weeks, but that's a selling opportunity that I'm looking for. And unfortunately, we just haven't had that. There's just been way too much bearish momentum in the last couple of months. Okay, the US dollar, DXY. So the US dollar, we saw a breakout above 105.50, all the way a rally to 107 or so. And then we saw this retest of 105.50, clearly acting as a very strong zone of support because we saw a very bullish candle just a few days ago, but price once again struggling to really break above that 107 area. So it could be in store for some more consolidation, but the macro thesis here for the US dollar is still a bullish one for a couple of reasons. One, high interest rate environment and more hawkish Fed indicating that interest rates could be elevated for longer, or even an additional interest rate hike being introduced. We know we are only going to get one additional interest rate hike so far, and that'll most likely be in November. But it looks like with inflation numbers still keeping persistently high, NFP numbers still keeping high as well, the Fed could easily turn around and say, look, we may need another 25-point hike, and that is going to act as a tailwind for the US dollar. But for the short term, 105.50 clearly holding as support. We could see a retest here in the next few days, but it might need to be a bullish catalyst to see a break above this 107.50 area. Now, usually when it comes to gold, I would say with a strong dollar comes weak gold. However, that has not been the case. So the conflict in Israel and Gaza has seen the safe haven metal move higher, push higher in price, right? We saw price bottoming out at around 168 and immediately shooting higher, breaking above its 21 and 55-day exponential moving averages, breaking above the 176 area of major support, and heading towards the next key level, which is 180. Price set to open a little bit higher this morning, and we could see a continuation here towards 180. And what would be really interesting is how price behaves at 180. It is a major resistance level, but we also have macro headlines and a fundamental thesis of rotation into safe haven, and gold is a safe haven commodity. So therefore, we could easily also see a break above that 180 level. I think gold would be very tricky to trade right now. And if gold did rally under normal conditions to 180, and it wasn't because of conflict or any geopolitical event, I would say 180 would be a great time to look for shorting opportunity. But for now, I'm a bit more hesitant. These types of events can really throw technical levels out of the window, and therefore I would still refrain from going short at 180 unless we see some developments in Israel, or maybe some good news from what's happening in Israel to see rotation out of a safe haven. But again, doesn't look likely for now. So for gold, tricky. 180 is tempting. For short, I would say just sit in your hands and let's see if gold does actually break out maybe towards 184, which could be another key area to short. But clearly there's a lot of bullish momentum here for gold. And oil. So oil saw a significant break above 83, major resistance level. This was due to supply shortages, right? And we know inventory levels are also low. And price did pivot at around 94, came back to retest at 83 level, and clearly acting as support now. So the upside, the bias remains to the upside. There's no doubt about that. But we could get another retest of 83 before looking for that bullish opportunity. So if you are trading oil, maybe the risk to reward is a little bit in a weird place, given the fact that price is still in the middle of no man's land. It's already bounced above 83. Maybe look for a retest of 83 for a better risk to reward bullish opportunity. But clearly you can see oil is on a bullish trend, and it could very well establish a new range between 83 and 93. So taking a look at sector rotation, 6 sectors in the improving and leading categories, and we have 5 in the lagging and weakening. Energy, providing leadership for quite some time, is starting to lose out on that relative momentum against the broader market, given the fact that the broader market is managing to stay elevated, but oil prices has quite recently declined rapidly. So we are seeing energy losing out a little bit there. Communications, on the other hand, a bit of finding some momentum, heading back towards this leading category. We also have technology as well, with communications finding that momentum. Discretionary, on the other hand, heading towards a lagging category, but with today's retail sales numbers, that could very well prove to be an upside catalyst to see a rotation maybe closer towards the improving category, or even back towards that leading category, especially when the earnings announcements for discretionary companies start to come out. Staples and industrials, both in the lagging category, and I would even put utilities in the lagging category. It's been rotating between lagging and improving over the last few weeks. And also real estate, significant weakness there, heading back towards this lagging category. Financials, surprisingly, still underperforming, but given the fact that this is a weekly sector rotational chart, I guess the new earnings announcements and the upside surprises from earnings hasn't really been factored in or priced into this chart just yet. So financials still, I wouldn't bet against financials. I think there's a lot weaker sectors out there right now, and with the recent earnings announcements, high interest rate environment, I do expect financials to still at least stay neutral. Healthcare doing quite well, but materials again heading towards this lagging category. So significant rotation here in the last 2 weeks or so, after maybe 2 or 3 months of very predictable rotation. Home builders, the XHB Home Builder ETF. This was a subsector that we looked at last week, and it was maybe a bit more of a risky trade, I'll admit. We saw price bouncing above 74, and we were looking for a very quick move towards 79, or based on 78, 79. We were looking for that area of resistance at 78, 79. The price did pretty much rally there, maybe a little bit shy but immediately reacting to that level of resistance and heading lower. So good time to take profits would have been at 78. But again, was very short-term entry, short-term trade, and we have seen, equities. We have seen the subsector actually reverse lower, but still staying above that 74 key level. So we could see another revisit towards 78 if you are looking for very quick in, quick out kind of trades. Home builders does seem to be providing a little bit of an opportunity here, especially with improving momentum as well, despite declining price. Good positive divergence. Okay, looking at Electronic Arts EA, this was a bullish trade from last week where we saw a breakout above that 124 level. It was a small breakout, and price actually, on the day that we had the market outlook, did gap up higher at around 126. So far, doing pretty well, rallying towards 132. However, 132 is a major level of resistance, as you can see. So a good time to take profits. So another very quick in, quick out kind of trade, but I wouldn't keep staying this trade for too long, given the fact that now the 50-period CCI has almost approached 400. So that's heavily overbought. Starting to recover from that, I do expect to see maybe a more deeper retracement, and therefore now would be the ideal time to take profits if you haven't already done so. So yeah, I mean, a lot of shorter dated kind of trade setups here, given the fact that we are seeing some volatility, given the fact that it's earnings season, and given the fact that there is geopolitical conflict, very difficult to predict markets in the medium term. Qualcomm was a bearish idea that we've had now for a couple of weeks, below, let's say, 113, and price so far still staying below 113. I am still targeting that 100 and let's say 102, 103 level, and it hasn't quite gotten there yet. So because of that, I think it's a good time to be taking profits. This was a credit spread idea, so it should still be quite profitable, given the fact that time decay is working in your favor and price is staying below that 112, 113 level, which was our thesis for this bearish trade. Unfortunately, it hasn't made a big move to the downside, but the trade structure that we proposed is still quite effective, even in neutral environments. So Qualcomm, probably thinking about taking profits now. Dexcom. So, and again, bearish here for the last few weeks, because we were initially bearish at around 108. Price made the initial move lower and then retraced higher, so it was a good time to take profits. And we entered again here at around 96 because that provided a good risk to reward bearish opportunity, where we saw resistance at the 21-day exponential moving average and also at the previous swing support level. So good risk to reward to the downside, and we knew that there was more room to the downside given the fact that that $80 major support area has yet to be reached, and now has been reached, as you can see. And now again would be a good time to be taking profits on this overall position, especially now that we're seeing positive divergence with momentum making a higher low, but price making a lower low. So that is now a bullish signal. I still wouldn't go bullish on Dexcom yet, but it does definitely indicate to get out of this trade. So a lot of taking profit trades now, especially given the fact that a lot of these were bearish ideas, and we are seeing equities starting to bounce up higher in the last few days. So IBM is a bearish trade that we're still going to keep with. When I suggested this trade weeks and weeks ago, price was at around 150. The reason we were looking at this as a bearish setup was because if I scroll back here, which I can't as it's a screenshot, but 150 has been a major resistance level over the last couple of years. Price had a strong rejection of 150, which provided an excellent risk to reward, long-term bearish entry point, targeting the major support level of 120, because price has been in this large range for the last few years. And for those of you that did join me in the last few weeks, I was essentially saying that we should break this up into a few trades. So look for the initial move lower, wait for retracement higher, look for another move lower, wait for a retracement higher, and then look for another move lower. So I do think we can still squeeze 2 or 3 trades here, and taking profits at 140 was the ideal opportunity, as I mentioned last week, as it was a minor support level. But again, good entry point at around 142, as now we see price breaking back below 140 and heading lower. So the second leg of this trade very much active, and I do still see some more room to the downside. Next key area of support sits all the way at 130, and that's when you probably want to be looking at taking profits. Or if you start to see some price action similar to what we saw the last couple of weeks, where price is starting to retrace higher, that will be another good time to be taking profits here on IBM. It's a long-term bearish view, and first trade went perfectly according to plan. Let's see how well the second trade goes. Okay, Comcast was a bullish play from last week, and it was bullish because we started to see communications find some support and find some relative momentum against the broader market. So we saw a breakout above 43, a gap up higher, and then a gap fill here back towards 43 and a bounce higher. So bullish price action at a key area. Price did rally to 45, came coming back a little bit in the last few days, and is set to open higher. Oh, sorry, moved higher yesterday and potentially set to open higher today, given the retail sales numbers. So our bullish thesis is still intact, but price has not moved all that much. And I think we'll just have to wait and see how this plays out over the next few days. But our target here is around that 47 area. And finally, we have Ford. So Ford was a longer term bullish play. When price reaches at let's say 1150 major support level. This wasn't really actionable when I mentioned it last week because this was more of want to add to the watch list. So if we do see price reaching that 1150 level, that will provide an excellent risk reward, longer term bullish opportunity, and potentially even simply buying the shares outright. Price hasn't quite gotten there yet. And if you were aggressive, sure, there's some support here at current levels. So you could look for a short-term bullish opportunity, but I still think that the better plan here would be for waiting for a retracement lower back towards that 1140 level, and then looking to maybe potentially buy those shares outright, because this is a major support level, as you can see on the weekly time frame. Okay, so with that, thank you so much for joining me. I hope you all enjoyed this webinar, and I will see you tomorrow, actually, for an educational webinar on cash secured puts. So very much looking forward to that. And again, thank you all for joining. Hope you all have a great trading week. See you tomorrow.